Thanks everyone for joining us today. We're representing the team from BDH Sterling as we present a great session outlining making the right decision about your UK pension in Australia. During today's session, we will share information and considerations around the types of pensions and where it may be possible to transfer and the logistics around doing so. The tips and traps around the process of undertaking a transfer and why it's necessary to gain advice to look at such transfers due to the complexity, and also for how you want to make the most benefit of the funds in conjunction with your overall financial planning needs. The first slide today that we'll have a quick look at is general information. So the general information warning here is talking about Australian and UK legislation dated 11th of September 2024, and anything we talk about today is general information only. It's not tailored advice to your specific situation. So before acting on any of the information contained in today's session, we would encourage you to seek tailored financial advice specific to your needs. So our presenters today, my name is Brenton Ritchie. I'm the Financial Planning Manager for the Australian division of our business. I'll be helping facilitate today's session and assist with the Q&A at the end. The most important person today is Charlotte Everard. We did have a late change to the lineup. Unfortunately, Nick Bond is not well today, but Charlotte's our Pension Transfer Manager and certainly does a lot of work with pension transfers and the team across the UK and Australia. Has been with BDH Sterling for many years and has over 15 years experience in the industry. She's got the tough job today of taking us through the main content you need to know about unlocking the potential of your UK pension within Australia. So we've broken the session today into 5 key areas. The first being the types of pensions and why it might be worthwhile to transfer. The second being QROPS, what is a qualifying recognised overseas pension scheme. The third, the transfer process. What it takes to transfer across and why advice is important. BDH Sterling, why it's good to get assistance from a reputable company, and the Q&A. We have absolutely allocated time at the end to answer questions you may have, so please feel free. You'll see the Q&A tab there. In the Q&A tab, we'll use that for questions and answers, and that'll give us a good ability to be able to group some together, make sure we tick them off as they go through, and we'll try and answer as many questions as possible within the hour time frame that we've allocated today. If we don't get through all the questions, we'll come back with any specific answers to questions that you might have post the webinar. So what we'll do now is we'll get stuck into the main content and we'll move through to the types of pension transfers and why to transfer, and Charlotte will take us through from there.
Great, thanks Brenton, and hello everybody, and apologies for my speaker issue just a moment ago. So first of all, we'll talk about the different types of company pensions in the UK. So first of all, what we have is defined contribution pensions, and defined contribution pensions are very similar to your ordinary superannuation in Australia. So contributions are made by yourself, your employers, while you're working in the UK, and then the fund value will depend on what's there when you come to draw an income from those in the future. They have many names in the UK over the years. The main names that you'll likely see are Personal Pension Plan, or SIP, which is a self-invested personal pension plan, or a GPP, which is a group personal pension plan. But there are lots of varying names of these, but they are essentially the same. We then have defined benefit pension schemes in the UK. So these can be private companies that you worked for, and then you have a defined benefit pension with those. They could also be where you've been a doctor or nurse with the NHS or worked in the army or the civil service. And what these defined benefit pensions do is they give you entitlement to a guaranteed income for life. So, for example, if you worked at a company for 20 years and when you left that company, you had an entitlement to a guaranteed income of £1,000 per year. What happens between leaving that company's employment and retirement, which could be 60, 65, that guaranteed income would increase, and then potentially it could be worth £1,500 by the time you retire. And generally that guaranteed income you're entitled to will increase throughout your retirement. It could be at a fixed rate, it could be by inflation, which is usually the way it goes, but that is a guaranteed income for your whole life. When you do get statements from these pension companies, usually they just tell you the income per annum you're entitled to, but you are also entitled to a transfer valuation. Usually you'll get one free per year from the companies. However, some will give you more than one a year. Some will also allow you to pay for an extra valuation. Every scheme is quite different. And when that valuation does come through, they are only valid for 3 months. So if you wanted to get advice on whether it was in your best interest to keep that pension or transfer it, you do only have 3 months, which may sound like quite a long time, but in this complex area of advice, 3 months is not quite long when we're dealing with the UK pensions. So next up, we'll talk about what types of pensions can be transferred and cannot be transferred. So first of all, the pensions that can be transferred. What can be transferred are those defined benefit pension schemes I mentioned, if they are from private companies. So if you've worked for a bank or private oil and gas company, those defined benefit pension schemes can generally be transferred. You then have the defined contribution pensions. Again, they're similar to super and they can certainly be transferred as well if you'd like to. Then you have defined benefit pension schemes if you worked for local government. So every shire in the UK has a little local government, and if you did work at those, the defined benefit schemes can be transferred from those. You then have QROPs and QNUPs. QROPs and QNUPs are pensions that are outside of the UK but were previously funded by old UK pensions. So QROP stands for Qualifying Recognised Overseas Pension Schemes. A lot of these are in countries such as Australia, Malta, Gibraltar, Jersey, and they would have essentially been funded by previous UK pension transfers. And if you do have one of these, they can certainly be transferred as well. Usually they do not have any guaranteed income on them, and they're the same as the defined contribution pensions, so the funds are invested for you. The QNUPs, again, that stands for Qualifying Non-UK Pension Scheme, and again, that would be contributions that you made whilst you were in the UK, or you transferred old UK pensions to those. So we'll then move on to those that cannot be transferred. So first of all, we've got the UK state pension. Most people will be entitled to, if not full UK pension, just a part of the UK state pension, and that state pension cannot be transferred. So your only option is to take the income from that. You can defer the income and take it later, but generally the UK government want that UK state pension to start being a payment. With the UK state pension, if you're not aware, you get entitlement to that by paying national insurance contributions. So in the UK, while you're working, you'll pay your tax alongside these national insurance contributions. To get the full UK state pension, which is about £10,000 currently, you would need 35 years of national insurance contributions. However, if you had 15 years of national insurance contributions, you could get 15/35 of that full UK state pension. It's quite a good amount, especially for a base in retirement. So that's a pension that cannot be transferred, but it's very valuable. We then have government unfunded pensions. So these are defined benefit pensions, but where you may have worked for the NHS as a doctor or nurse or in the army, these defined benefit pension schemes don't have a fund value as such, and they are funded for the retirees through tax payments. So those pensions cannot be transferred. The only option with those is to take the guaranteed income at a certain retirement age, or some will allow you to defer retirement a few years, but you do have to take that income. We then have company pensions in the PPF that cannot be transferred. So the PPF is a pension protection fund in the UK, and what the pension protection fund does is, if you have defined benefit pension schemes where the private company fails and does not have the assets to pay the pension income to the retirees, the fund goes into the PPF. And what the PPF does is, if you're already taking the guaranteed income from the private pension, they'll guarantee 100% to you, and you'll still get exactly the same income paid. However, if the company fails and you haven't of the income, so you do get a bit of a 10% drop there, but you still do get the guaranteed income. So they cannot be transferred once they've gone into the PPF. And then lastly, we've got annuities purchased in the UK. So an annuity is where a lump sum is used to purchase guaranteed income for life by an annuity company in the UK. It's very similar to Australian annuities. However, the difference is, in the UK, once that income is started with the annuity company, you cannot get any capital back, you cannot stop the income, it's just there, and you cannot transfer it out. So all of those pensions cannot be transferred, and they have to stay in the UK. So we'll then move on to Australian QROPs. So if a transfer was advised, then there are only two places where the UK pension funds can be transferred. One of those is an SMSF, a self-managed super fund, and the other is a retail fund. So a retail fund is very similar to your ordinary super here that you may have. And a self-managed super fund is more where you are the trustee and you have a lot of involvement in terms of managing those funds. So QROPs have a few things that they have to do whilst being a QROPs. And first of all, they have to report things for 10 years to HMRC. So it's not an annual reporting requirement, it's just when certain things happen. So for example, if an income is started, a lump sum is taken, you move address, just things like that. So when those things happen, a form gets filled out and sent through to HMRC to let them know. So that's for 10 years. The QROPs then has to ensure that the benefits are received by the person taking the income in line with UK rules. So, for example, there are certain restrictions in terms of you cannot invest in direct residential property inside of QROPs because that's restricted in the UK, or you cannot have income protection inside that QROPs because, again, it has to mirror the UK. The other thing the QROPs must do is comply with what's called the member payment provision period. So these are certain rules in terms of if you'd like to transfer that QROPs to a non-QROPs, for example, your ordinary super here that isn't a QROPs, then there has to be certain things met for that to happen. So the QROPs must ensure those things are met too. So we'll then move on to why transferring may or may not be suitable for you. So it may not always be the case that a transfer is suitable depending on your own personal circumstances. So if you did have a defined benefit scheme, in the UK, the FCA, who's the regulator, the Financial Conduct Authority, they say that if you do have a defined benefit scheme, it's a very good pension, and ideally you shouldn't transfer out, you should retain that guaranteed income because it's very valuable. So what our job to do is to look at that pension, your overall situation, and just make sure that it is suitable for you to transfer out of there. It may be also that it's not tax or cost effective. So you could have a very low cost UK pension compared to transferring that to Australia, where there could be higher charges or there could be more tax by transferring it to Australia. So again, it's just making sure that it is going to be cost of tax effective for yourself. It could be then that the current UK pension scheme has very good performance. Sometimes we see some of the older UK pension schemes do have guaranteed growth rates on them. A common one is a 5-6% guaranteed growth rate per annum. And if you're not into risky investments and you just like a steady return, maybe that's something that's suitable for you rather than transferring and putting it into investments that could be a little bit more volatile. On the type of scheme you've got, if there's a large exit penalty, you have to be out on whether it's taking the hit on or it's best to keep that so that you don't have to pay the large exit penalty. Again, if we think about defined benefit pension schemes, all of the risk is on the private company, because they are investing the money and they are responsible for providing that income to you. And that's compared to if you did transfer and give up that guaranteed income and invest the money in another pension, you are taking on that investment risk from your previous employer. So that's the reasons why it may not be suitable for you to transfer. And we'll move on to why it could be that you may want to transfer. And one of the big ones is currency control. I'm sure many of you have traded funds from sterling into Australian dollars throughout your time here. And I'm sure every time you've done it, you've got a different rate. So if we look at the graph we've got here, it shows the previous 5 years conversion rate from sterling to dollars. And you can see here there's been a high of just over $2 to £1. And there's been a low of just over $1.6 to the pound. So it varies a lot. And if you are taking, let's say, a monthly income from the UK of £2,000 a month, it could be $3,000 one month, $4,000 the next month. So it's quite a big risk to have that currency risk in the UK pension. So if you did transfer, you could convert the funds to dollars, take out that currency risk, just to give you a bit of comfort, you know exactly how much money you've got there for your retirement planning. The other benefits of transferring are estate planning and investment control. So if we think about defined benefit schemes, If you're taking the guaranteed income and you pass away, generally your spouse is entitled to 50% of that guaranteed income. However, upon your spouse's death, it could be that your children are not entitled to anything from that pension, because the defined benefit pension schemes really only give an income to a child under the age of 21 in full-time education. And so if you did transfer out of there, you would be able to pass on 100% of the fund value to your beneficiaries. And in the UK, there are rules in terms of the age someone passes away. So if you're under the age of 75 and you pass away, 100% tax-free can get passed to your beneficiaries. However, if you're over the age of 75, there's higher tax consequences, so you wouldn't be able to give 100% to your beneficiaries. And that's compared to moving it to Australia, where 100% of your super balance will be able to be passed to your dependents. We then have investment control. So with the defined benefit pension schemes, the investment control is all under the private company that you used to work for. They will make the decisions in terms of the investments. However, if you wanted to take control of that and have a bit more input with the investments, that could be a reason that you may want to transfer your defined benefit pension scheme. Or if we're thinking about the defined contribution pension schemes, it could be that you'd like to have more options in terms of investing in Australian dollars, and your current UK pension only allows pounds investments. So that could be a reason to move into another product just to have more control and more options with your UK pension. So we've then also got the tax treatment, and I will go into a little bit more detail over the next couple of slides on this, but a lot of the time it is quite tax effective to move UK pensions to Australia. And then you may also want to consolidate your pensions. So you may have 2 or 3 UK pensions, a couple of Australian supers, and you may just want everything in one place just for ease of management. So what could be done is potentially moving those all to Australia, combining them if advised, just so that you know everything's in one place, it's easier to manage, just so you can plan a bit better for your retirement. So if we next move on to the tax, if we look at the tax on keeping your UK pension, just over to the next slide on the tax, then if you kept the UK pension and you took a regular income from the UK pension, what would happen is there would be tax in Australia at your marginal income tax rates here in Australia. There may be tax deducted at source in the UK, however, you could reclaim all of that tax from HMRC there. And that's because there is a double taxation agreement between Australia and the UK. And within that double taxation agreement, the 2 countries have agreed that Australia has the taxing rights on that regular income. So what would happen is you take your regular income from the UK pension and you put it on your tax return here in Australia. We then have the 25% tax-free cash. So many of you may have seen this on your UK pension statements. Even if you call up the UK pension companies, they'll talk to you about 25% tax-free cash. So the 25% tax-free cash is tax-free if you live and are tax resident in the UK. However, if you live in Australia and you take this 25% tax-free cash lump sum, it isn't fully tax-free for you. So what would happen is in Australia, they would class that as a lump sum from a foreign super. And what they will do is they will calculate how much growth there's been since you arrived in Australia. And that growth since you've arrived in Australia will get taxed at your marginal income tax rates. So as an example, if you took $50,000 from the UK pension as the 25% tax-free cash, and since you've been in Australia, your UK pension has grown by $30,000. $30,000 would get added to any taxable income you've got in Australia and taxed at your income tax rates. And then the further $20,000 would not get taxed. So this is something a lot of people get caught out with. So it's really important before you're going to access any money from a UK pension, you just double check, take advice, make sure you're doing the right thing so you don't have any adverse tax consequences. If we then look at other lump sums are not in a double taxation agreement. So the 2 countries haven't put that and said, okay, which country is going to tax it? So essentially it's taxed in both countries. And it really depends on the type of payment as to what tax that could be. Because in the UK, there are many different types of lump sum payments that can get taken. So again, lump sums being accessed, it's really important just to take advice to make sure that things are done in the correct way. So next we'll move on to the tax on transfer to Australia. So if you had a UK pension and it was transferred to Australia, what happens is your UK pension is broken down into two components. The first component is any growth since you arrived in Australia, and that growth portion is transferred over to Australia Super, and it's taxed at 15%. And that growth portion doesn't count towards any of your contribution caps here in Australia, so it doesn't matter how much that is, it gets transferred and taxed at 15%. Any money that's left over in the UK, that comes over tax-free. However, it does have to come over in line with what's called non-concessional contribution caps. So in the current financial year, that non-concessional contribution cap is $120,000. And at the moment, you can use 3 years in one go. So if we were to make a transfer today, we could potentially transfer $360,000 if you had the full allowance. And then you couldn't make any more non-concessional contribution caps for 3 years just because you've used those 3 years non-concessional contribution caps. So initially, you can transfer quite a large balance across in the first year. However, if you do have a very large balance in the UK, it could be that it have to be done over a few years. So next we'll move on to the options. So the golden age of 55 is the golden age of pension transfers. And if you are under the age of 55, you cannot transfer your pension to Australia. So if you're under age 55, you have a couple of options, and those are you can leave your pension as it is in the UK because it's a great pension, it's doing well, and you might want to review it later. Or it could be that the UK pension is transferred into a different UK pension, such as the SIP that we discussed earlier. And that could be because you may want to trade it into Australian dollars and invest it. You just want to have more options. Maybe your current pension is a little bit limited. So if we look at what is a UK SIP, next up, a UK SIP is very similar to a personal pension scheme in the UK. The funds are invested, you have a range of investments that are approved, and it's very similar to a self-managed super fund here in Australia. So you would have the product provider who is like the trustee, and then you would have a platform within there where your funds are invested. You have pounds investments, you have Australian dollar investments, and it's a lot more flexible. So what are the benefits of a SIP? If we move on to discuss the benefits of a UK SIP, as I mentioned, they can be denominated in sterling or pounds and invested in both of those currencies. And again, you can pass 100% of that pension to your beneficiary if you pass away under the age of 75. You can then have as much or as little input into the pension investments as you wish. The UK does have a lot of investment choice, very similar to superannuation here. There's lots of investments that can be chosen from. So we then look at case study. So here we have John, and John is age 53. So John has 2 company pensions in the UK, defined benefit schemes, and those defined benefit schemes total approximately $350,000. And John would like to transfer to Australia. However, he isn't 55 yet, so we do have to keep those funds in the UK for a couple of years. So what we do is we consolidate those 2 company pensions for John, and we put them into either a SIP or a personal pension in the UK. And what we do is we talk to John, see what he'd like to do. And if John would like to take out that currency risk, he would have those invested in Australian dollars. And then we'd look after those until John was age 55. And when John is age 55, we'll set up a CUROPS in Australia, and we'll bring over the funds in line with the non-concessional contribution caps, as well as that growth portion since arriving. So that's what we would do with John. And just a caveat in terms of the age 55, from the year 2028, that age 55 is going to be increasing to age 57. So the UK government have changed the access age from 55 up to 57 in the UK. So that will slowly be coming in for some of you. So next up, we'll move on to transfer options if you are over the age of 55. So if you are over the age of 55, the option is to transfer to a CUROPS, the Qualifying Recognised Overseas Pension Scheme. That's the option you have. And again, you also still have the option to leave the pension in the UK. So it could be that you have a defined benefit scheme and the income is great, and you'd like to keep that pension scheme, or it's been reviewed and it's in your best interest to retain that, then it could be that the pension stays in the UK. So next we'll move on to section 2. So section 2 is about QROPs. So QROPs has had a lot of things happening in the past. They were introduced in 2006 as an overseas pension scheme that was registered with HMRC to accept UK pensions. And what that did is it allowed people moving to various countries to transfer their UK pensions so that they can then comfortably retire in the country that they're residing in. It definitely makes it easier to have the pension in the same country that you're in. So if we next look at the legislation changes that have happened throughout QROP's time, back in 2015, before 2015, you could transfer some of your government pension schemes. So if you worked in the army or the NHS, you previously were allowed to transfer out of those defined benefit schemes. However, in 2015, that was stopped. So you couldn't transfer out of those types of schemes anymore. And then what happened was HMRC then introduced the pension age test. And the pension age test is the age 55 test for QROP. So HMRC, they didn't like it that some countries allowed people to access their UK pension funds under the age of 55. So they made sure that all QROPs had the pension age test so that you couldn't access unless you were 55 and over. What this meant, especially in Australia, is that there were many QROPs that came off the QROPs list. So over 1,600 QROPs had to come off the list because they allowed people to access their pension funds under the age of 55. And in Australia, the main reason for that is that in Australia with superannuation, you have the financial hardship rule. So you can access your super if you're young, if you are under financial hardship, and HMRC didn't like that. So they made sure that there was a caveat in the QROPs here in Australia that you couldn't access it unless you were over the age of 55. So also in 2015, the FCA introduced that if you had a defined benefit scheme and the value was over £30,000 in terms of the transfer value, you had to take UK regulated advice by someone who was a pension transfer specialist. So you need a specific exam to be able to advise on those types of pension schemes. So we then fast forward a couple of years to March 2017, and the UK introduced what was called the overseas transfer charge, and that is a tax of 25% if you transfer your UK pension to a country where you do not reside. So if you lived in Australia and you transferred your UK pension here, you wouldn't be caught by that. However, if you lived in Australia and you transferred your UK pension to Malta or France, then you will pay that 25% tax because you don't reside there. Again, in 2000, the non-concessional contribution caps used to be much more. You used to be able to transfer $150,000 into super in one go, and now that's down at $360,000 that you can transfer. So it got reduced quite a lot, which affected quite a few transfers. So in terms of the QROPs, there are quite a few benefits of the QROPs if you did transfer your UK pension funds to Australia. One of those is it's in the same country as you. So I'm sure a lot of you have got family and friends still over in the UK who you have to talk to, and the time difference doesn't make it very easy. So by having your pension in the same country as you, an advisor who's looking after that in the same country as you, it really does just help you manage your retirement by being on the same time zone. Once your funds are here, they can also be invested in Australian dollars and sterling. Of course, it's likely that you'd want to take out that currency risk, so having those in dollars in Australia is worthwhile. You then have Australian super. 100% of those can be passed to your dependent tax-free if you pass away, so it's a big benefit for estate planning purposes. And you then have the tax treatment benefits. As I mentioned earlier, on transfer to Australia, you're only paying 15% tax on a portion of the transfer. And then when the funds are here, you're drawing them down tax-free. So it's very good in terms of tax efficiency. We then have that your UK and Australian pensions can be consolidated. So if you've got UK and Australian assets, they can just be pulled together, could be more cost effective, and it's all in one place, easier for you to manage. So CureOps do have a few responsibilities. The trustees of the CureOps, first of all, they have to report things for 10 years. As I mentioned earlier, it's not an annual thing, it's just random. You take a lump sum, start an income, things like that. So it's just a few things that have to be reported for the first 10 years. And they also have to ensure the benefits are received in the same way as the UK. So again, as I mentioned earlier, there are restrictions in terms of no direct residential property, no income protection insurance, and just making sure that people aren't accessing those funds under the age of 55. So we move on to section 3 of the presentation. That's in terms of the transfer process. So at BDH Sterling, we are dual license financial planners in terms of UK and Australia. So we have a streamlined advice process to help you navigate the complexities of this area. So what we provide is we have an initial meeting, no obligation meeting, no cost. At the meeting, you'll meet with a planner to go through what you'd like to achieve, what sort of pensions you've got, and just review these options to see if there's something that we can potentially help you with. And if it is that you'd like advice on those pensions, we will complete a pension transfer analysis report and a full review of your UK pensions and Australian assets too. And we'll go through that document with you, make sure you fully understand it, whether that's retain any of your UK pensions, transfer them to Australia. And then what we'll do is, if you're happy with that and the transfer is recommended, is we'll go through the process of implementing that for you. So we can help you navigate moving those pensions to Australia advised, and once they're in Australia, help you navigate things in terms of your retirement planning. So what we'll do now is just go over a quick case study for someone who's over the age of 55. So if you're over age 55, you can transfer to a CureOps in Australia. And here we've got Janet. So Janet's age 60 and she's got a defined benefit pension scheme, and the transfer value of that is $740,000. And Janet would like to move her pension to Australia as soon as she can. She'd also like to access a lump sum to pay down some of her mortgage. So what we do for Janet is we move that defined benefit scheme into a SIPP in the UK, and at the same time we set up a CureOps here in Australia. So once we've set up the CureOps, we'll then commence a transfer strategy. So if we look at Janet's $740,000, for example, let's say since Janet arrived in Australia, $140,000 of that amount is the growth since she arrived in Australia. What we'll do is we'll transfer over that $140,000 of growth. That will get taxed at 15%, that growth portion for Janet. And then what we'll do is we'll transfer over $360,000 tax-free as a non-concessional contribution for Janet. So straight away, we've got quite a chunk of that money over for Janet. And then what we'll potentially do is look at what's best for Janet in terms of accessing a lump sum tax-free from her super to pay down some of her mortgage, or is it more tax effective for Janet to access some of the remaining UK funds to pay down her mortgage? If there are any funds left in the UK, what we'll do for Janet is we'll invest them in pounds or dollars until her non-concessional contribution cap resets, and we can move over the rest of the funds. So as you can see, it's quite complex in terms of the different strategies and moving funds over different financial years and ensuring that it's all done within the contribution caps. There's also a lot of different tax legislation changes in Australia, in the UK. Right now in the UK, over the past year, there's been some changes in terms of something called the lifetime allowance. There's been changes a year ago, there's going to be some more changes coming for it. It's quite complex. So again, it's just making sure you're up to date with all of those changes in legislation and making sure the right thing is done, because if the wrong transfer is done, it's done in the wrong way, there can be tax of up to 55% if the transfer is not done correctly. So these are your retirement funds, so it's really important that it's done properly just to make sure that you can retain the value that you've built up over the years. It's also important to confirm if a UK pension can be transferred. Sometimes the paperwork looks like it can be transferred, however, it cannot. So for example, some defined benefit schemes give a transfer statement, however, they can only be transferred to different UK pension schemes that are in the same sort of group. So it can be quite complex, so just confirming that it can be transferred is definitely important. So next we'll move on to section 4 of the presentation, and I will hand that back over to Brenton to carry on with you.
Perfect. Thanks, Charlotte. So why BDH Sterling? So BDH Sterling is a chartered firm in the UK. For those who haven't seen what chartered firms, the ability to get chartered status is quite hard. And from an Australian point of view, we're the only Australian-based pension advice firm with chartered status as well. So certainly a big milestone there, or big hoop and hurdle to jump through and over. We've got dual licensed advisors in both jurisdictions. So within Australia and within the UK, we've got advisors in each jurisdiction, and also with Charlotte's team and a few of the other advisors, we've got people who are accredited in both jurisdictions at the same time to cover off the advice needs of clients. Defined benefit scheme specialists, we do spend a lot of time making sure our knowledge and abilities around the defined benefit space is top notch. 15 years experience in UK pension transfers. So just last month, BDH Sterling racked up its 15th year within the industry as well. So certainly long-term tenure and a lot of experience in pension transfers, pension transfer advice. The advice is provided in-house for both Australian and the UK through our global offices, which is a bit different than what we see within the industry. So we certainly do in-house the pension transfer advice and the Australian-based advice, or UK for residents who are still residing in the UK as well. We do see a lot of outsourced work that's done at times, but we certainly do that advice within the bounds of BDH Sterling. We're able to provide advice in other financial services areas as well, such as Australian Super through the Oz Advice team, tax advice through a sister company BDH Tax, and obviously with retirement planning and what that means into the future for clients that we continue to provide ongoing advice for. So we'll just get that clicking through again. So if you want to engage with a financial advisor in one of the teams, certainly send an email through to inquiries at BDH Sterling. We're keen to be able to assist, or at least if we can help you get in the right direction, we'll certainly take those steps to get you into the right direction. So help us out a little bit there as well. Give us an idea of what you're looking to achieve, a few basic details from yourself. So age, at the moment, you would have heard from Charlotte there that the ability to transfer pension has certain age requirements, and a bit of background about asset position and what you're looking to achieve with broader advice or retirement planning as that all plays through. So before we go into the Q&As, I'll just say quickly thank you to Charlotte for taking us through the contents of that presentation. We will now go through some Q&As. As we get into that, I'll give a quick reminder that the session is recorded. So some of the content that Charlotte's gone through, or the questions that we answer on the go now, will certainly be as part of that recording. So please feel free to type questions into the Q&A section. We'll try and answer as many of those as possible, and if we don't get through them all, we certainly come back and answer the specific questions post the webinar as they come through. So drop them into the Q&A section, and we'll certainly try and answer as many of those as possible. We might grab the one that's in the chat first. So Charlotte, in the example of Janet, who's over 60, why does she need to incur the added cost of setting up a SIP? Why not transfer direct from her pension funds?
Yeah, perfect. So it all depends on how much that growth portion is that I mentioned. So if we take off the growth portion since Janet's arrived and there's too much money left over to transfer and we'll breach the non-concessional contribution cap, it could be that we need to move the pension to a different pension that can break it up and move it over in partial transfers. So one of the really big things is if you do not transfer the whole of a UK pension across and deplete the value to zero, that growth portion will not get taxed at 15%. It will get taxed at someone's marginal income tax rate. So what we need to do is sort of put it into a separate little account within a different UK pension so that to ensure that it does deplete to zero and there is that 15% tax rather than a large tax bill. So we definitely do an assessment. If we can transfer it all over in one go and we don't need to use a different new UK pension, we'll certainly do that. We make sure that we do the most cost-effective way so there's less fees for people.
That helps line into the next question that's come up there, Charlotte. I might give this one to you. So more around, have we done an assessment of what is the minimum UK fund value that warrants the cost of setting up a SIP, transfer costs, QROP setup fees in Australia, annual reporting and audit fees on the QROPs? So it might not be an assessment because each client will be different as to what they see as valuable. But Charlotte, do you want to give a bit of background as to where it might get to a break-even point for most clients of, yep, this actually makes sense from a cost comparison to a client point of view?
Yeah, sure. It's definitely individual to someone, and the main thing with that is how much growth has there been since someone's arrived. So if there's really not a lot of that growth portion that's going to get taxed on transfer, and most of it can come over tax-free, then you know, it's good to move it over. You may pay a little bit in terms of costs, but then you're going to save so much more tax. However, if you've got someone with a large amount of growth since they've arrived, and the UK pension is not too big and they've got no income in Australia, maybe it might be more beneficial to drip feed that income out under the sort of tax-free allowance here in Australia. So again, it's definitely case by case. It's not a specific amount, but again, we just make sure that we try and use other UK pensions that are low cost that are going to suit the client's needs.
One of the flow-on questions as well we typically get along those same lines is, when the funds come to Australia, and if a self-managed super fund is set up, what sort of value would the self-managed super fund be for it to be worthwhile? There's a fair bit of literature within Australia on that. Some will say $150,000 is suitable. More so now we're seeing that $250,000, $300,000 of fund value is what's suitable to set up a self-managed super fund in Australia as well. So if there are other options, there's limits on what those options are, as Charlotte mentioned a bit earlier, but there are other more retail options which wouldn't necessarily have the individual control and trustee discretion that you might be looking at, but have the ability for control of investments, lower cost investment options typically as well that can come from that, and take those trustee obligations away from an individual. Charlotte, around ISAs, investments in ISAs and how they're treated in Australia, is it better to liquidate them before moving and then set up a SMSF within Australia?
Yeah, great question. So ISAs in the UK are separate to UK pensions and self-managed super funds and super here. So it's an investment account in the UK. If you live in the UK and a tax resident in the UK, you can withdraw those funds tax-free. There's no tax on the gains. However, if you are a permanent resident in Australia and you do sell an ISA or you change the investments within an ISA, there would be capital gains tax. So you would have to engage with an accountant who can calculate that capital gains tax, or engage with a financial planner who can advise you on sort of what to sell and when, and where the best place for those funds to go is.
Thanks, Charlotte. The next question is, can you do an over 55 if currently age 61 transfer if you're currently under a TTR pension, I'm assuming within Australia? Currently, if you're not on a TTR, currently the question is, I'm not yet on a TTR, but maybe looking at setting it up, and currently still working. Charlotte, do you want to quickly give a bit of background on the abilities of, if a pension does come across, of what TTR abilities are there, and then maybe link into what that means from a full retirement point of view?
Yeah, so if you do transfer UK pensions across into a superannuation account here, the Australian rules in terms of access apply. So to be able to access your Australian super, you have to meet what's called a condition of release. And in very, very simple terms, because there are quite a few, but in simple terms, it's age 60 and you've stopped working. Or if you're still working at age 65, you can then access your superannuation if you want to access it in full. However, from age 60, you can do what's called the transition to retirement and take out 10% of your super. And there's no restrictions on that. So as soon as you bring over your UK pension, if you meet one of those Australian requirements, you can then start the TTR pension. It's not going to affect that.
Thank you. I'll jump back to the chat. There's one that's come up in there. Previous research revealed there was only one QROPS regulated fund that's not SMSF in Australia. Correct, that is still the case. So SMSFs can have QROPS status. There is a retail fund. I can tell you from our perspective, we're encouraging in most conversations we have with providers out there to look at what it takes to set up QROPS retail funds within Australia. So there's potential for additional options out there as well. There's a lot of logistics around that and a lot of trustee obligations around that, which makes it a little bit difficult, but certainly there's opportunity for more market players out there, we would feel as well. I'll give you this situation, Charlotte. By the time my Australian parent visa comes through and hence we will move, my pension will have been crystallised 10 years previously. Previously took the 25% lump sum at that time, and since then it has disappeared into spending, other investments, etc. How is tax on that tax-free lump sum calculated?
So if you're in the UK and you're waiting for your parent visa to come through, then it would be likely that you're a UK tax resident. So that tax-free cash lump sum would be tax-free if you're in the UK. However, if you are in Australia and you're waiting for your parent visa, if you're on a temporary visa here, then you wouldn't pay tax on that UK lump sum because you're a temporary visa holder here in Australia. However, if you're in Australia and you're a permanent resident, that's when you're going to pay tax on that lump sum at your income tax rate, depending on the growth since you arrived here. So it will be worth checking what sort of visa you're on while you're waiting for the parent visa, because there are a lot of different types of visas. It's sometimes hard to keep up with all the different ones. So it's important to just check exactly if you would be classed as a permanent visa holder while waiting for that parent visa to come through.
Excellent. So there's a question around transferring direct to a QROPS without first transferring to a SIP, and the fund paperwork that the individual says it has to be transferred direct. Absolutely, there will be instances where the transfer is direct. There are absolutely as well instances where it can be more beneficial to do that over multiple tranches and whatnot as well. Charlotte, I might get you to elaborate. You're certainly more technically proficient at that than I am.
Yeah, so again, it's all around how much there is in the UK pension. You know, if it's a small enough UK pension that can come over all in one go, then certainly it can go direct. If you've got a defined benefit scheme with that 3-month expiry date, like I mentioned, 3 months is not quite long. So to capture that value, it may be that we need to put it into a sort of interim UK pension. However, where we can do a direct transfer, we will to make it easier.
Thank you. There's a question that's come in around the cost to transfer a SIP worth £200,000 to a QROP fund in Australia, and similar cost to transfer into an SMSF. I think these are good questions, and I think they're really ones which instigate the need to sit down and have a chat to one of the team and talk around what the steps in that process are and how long that might take from first transfer to second transfer, depending on balances. We certainly are open and transparent with our fees and charges. Sitting down gives us the ability to go through what the steps are, what the logistics are of being able to get the pension transfer advice done, what that means of when, for how long it may sit within the UK before it can transfer to Australia, and then what the setup costs are. It's difficult to just go straight off the bat without getting some of those intricacies. So appreciate that that question's there. Certainly one which I think post this, sit down, have a quick chat. We can, Nick Bond, who does a lot of our initial conversations, can certainly have that conversation. A little bit more specific about your situation, but can take you through what that would be. Is it possible to move into a QROPS if I've already taken some out of my pension's lump sum and it's currently in drawdown?
Yeah, so it depends what type of pension that is. If we think about defined benefit scheme pensions, if you've started that income, you cannot then transfer out. So if it's a defined benefit pension, you just need to keep taking that income. It's the only option. If it is a defined contribution pension where the funds are invested and you've taken a lump sum and you're taking an income from there, then it can still be transferred to a QROPS. It just depends how much is there and what sort of strategy we need to do to get those funds over. So again, can we transfer it all in one go? Is it possible to split it up depending on the type of pension scheme you've got? It just needs a little bit more research, but it can certainly be done.
Thank you. The next one, is there a limit to the total amount over time that can be transferred into a SMSF per individual, or assuming 2 beneficiaries in total? It doesn't matter if it's an SMSF or if it's a retail super fund within Australia. There are limits in how much you can get in, but the limit's pretty open. The limits are really of how much per year within the contribution limits, be that non-concessional or concessional limits, that you can get in, ideally without breaching those and being open to excess contributions tax. One of the intricacies that comes in is how much can you get out from the UK and across into Australia within those limits, but also within the limits of getting the funds out of the UK as well. There are some total balance limits within Australia. There are some additional taxes which apply over that, but you'll find that most people, it'll be the limitations in what you can get in certain periods of time within those non-concessional caps of 120,000 per year or 360,000 over 3 years, or the amounts of concessional that you can get in each year. Again, it goes back to getting advice of what that looks like and then working out how much, how many years. And we have some clients who we may be actually working with them for 10 years, 5-10 years, to be able to get their funds across into Australia. And there's some clients that work with us that we won't be able to get the full amount across in a time frame that their eligibility to contribute within Australia will still be there. And therefore we need to look at other ways of getting those funds across for those clients as well. A DB pension, Charlotte, which is already in payment in the UK, can that be transferred to Australia?
So that cannot be transferred. If you've already started the income from your defined benefit pension, you just need to keep taking that income and putting it on your tax return here and paying the income tax. Unfortunately, there's no option to transfer that.
Excellent. Okay, if a migrant decides to return to the UK having previously transferred pensions into QROPS, can the process be reversed and funds returned to the UK without major tax consequences?
Yeah, so the transfer from the the transfer from the UK to Australia is one way. So you cannot then move the QROPS back to the UK. If you move back to the UK and you still have the QROPS and you started an income from that QROPS, what would happen is it would get taxed at your income tax rates in the UK. So you wouldn't really want to pay tax on transferring over, and then when you go back, you're paying tax on withdrawing it. So if you are thinking of transferring, it's really important that you feel that you are going to stay in Australia and retire here, because it is one way. The only option you do have is you can take the money out and go back to the UK, but that might not be tax effective for you depending on your situation. So again, before you do make a move and you've got assets in different countries, again, it's just really important to just get specialist advice to make sure you're doing the right thing.
Perfect, thank you. We might go through these last two. We're getting close to time, so we might go through these last two and then look to wrap up. Question is, I already have an old super account in Australia. If I start the transfer of my UK pension, can I pay into this also via other cash, or will the $120,000 per annum limit apply? Yes, the $120,000 per annum limit will apply for after-tax contributions into it. So again, that would be the conversation to have with the advisor and pension transfer specialist around what is the amount of total fund that's actually there that would be looking to be transferred. Is it within that limit? How much would you then contribute out of other cash funds in Australia as well? You still do have the bring forward amounts. So if you went in a 1 year period of time without having excess contributions from previous years, you can then trigger the bring forward. So again, the team will work through what that transfer process, what the amounts per year look like, and we'll certainly do research into the funds you've got in Australia, contributions in Australia, and look to give you guidance around amounts and process and timings of what should actually happen there. But it is possible to make contributions into your fund with other cash funds in Australia. How long will the process of transfer from a SIPP to a QROPS transfer to Oz? How long will that take? Charlotte, I might give you that one.
Yeah, so the process is not quick in terms of if you've experienced rollovers from super to super in Australia. It's definitely a process that's a little bit longer. So I generally like to say between 6 to 9 months from engagement to funds actually landing in Australia. And a lot of that time is dealing with the UK pension companies. So if you've got a modern UK pension, it's going to be quick. You know, we've seen it happen in a few months. However, if you've got one of the older style pensions where they still like to have paper applications, original signatures on documents, things like that, it can definitely take a lot longer. So it's a lengthy process. So we just we have a UK office. So luckily for us, we've got our UK office who are dealing with all these UK pension companies, which definitely makes it easier. But it's a bit of a long process.
Perfect. I know I said 2 more and then we'll wrap up. We've got 2 more and I reckon we can squeeze in the wrap up at the end. So if I'm in my 70s at the moment and have been residing in Australia since 2015, as it was fairly small, I decided to leave my pension in the UK. Will I be charged capital gains in the UK if I start moving this pension to Australia now?
So if you would like to start moving it to Australia in terms of taking an income into your bank account from the UK pension, what will happen is you'll have to put that income you're taking on your Australian tax return and pay income tax on it. If you wanted to transfer that UK pension to Australia, it wouldn't be capital gains tax, but what happens is the UK pension is broken down into 2 components. So the first component is any growth since you arrived here. I think it said 2015. Any growth since 2015, you would pay tax at 15% in the super, and the rest of it would come over tax-free. So it is a tax, it's just not capital gains tax.
Excellent, thank you. And the last one there is, can existing Australian QROPS be topped up by a transfer of a SIPP in the spouse name in the UK? Potentially, but not really. So within Australia, typically a superannuation fund is in the name of an individual. So there's potential that the self-managed super fund can be contributed into in the name of the spouse, but the spouse would need to be made a member of that fund and have eligibility to make the contribution into that fund at that point in time. If it was a retail fund, then no. The retail fund would be set up in the name of the individual. They could still make the transfer in, but it would be, say, in my name, not in the name of my spouse, because I'd be making the contribution into that fund. Again, really good questions that have come through there. And again, they're ones which certainly the broader team are more than happy to ask and take you through and help with a bit of context guidance and certainly take you through the advice journey there as well. So thanks again, everyone who's taken some time out of their day today to attend the webinar. We trust the session and information has been useful for you. A recording of this session will be forwarded to you over the next 48 hours, and we'll reach out direct if there are any specific questions that come through post. I'd encourage you to please keep an eye out for the feedback survey as it comes out. Your time with that would be greatly appreciated, and that will come from surveymonkey.co.uk. For those who are looking to seek advice on what your situation may allow and specifics of what apply to you, please feel free to reach out to us at inquiries@bdhsterling.com. Once again, and on behalf of BDH Sterling, thank you for your time.